welcome to the research desk.
Glad to be here.
So to start us off today, I want to take us back to 1929, the Radio Corporation of America, RCA.
Ah, right. The undisputed titan of tomorrow.
Exactly. I mean, the technology of radio was going to permanently transform global communication, right? News distribution, entertainment, all of it. And the underlying innovation was entirely real.
Oh, absolutely real. But the market's reaction?
Pure, unadulterated fantasy. I mean, RCA's stock exploded from roughly $1 a share to, get this, $573.
In just a few short years.
Yeah.
Right.
And it was all fueled by, dinner table chatter, breathless newspaper headlines, this intoxicating belief that the future had arrived early.
People thought they couldn't lose.
They really did. The technology changed the world, but the investors lost absolutely everything. So what actually happened when the spell broke? Think about this for a second.
The environment shifted.
It did. The macroeconomic environment shifted, the narrative couldn't sustain its own weight, and the crash was apocalyptic. RCA collapsed from $573 down to $2.62.
Decades of wealth just evaporated in months.
Exactly. And we're examining this today because it exposes really the fundamental divide in how wealth is generated and destroyed in modern financial markets.
It sets up the whole tension. Yeah.
Right. Because markets do not move by the steady, rational hand of fundamentals. They move by the wild, unpredictable pulse of narrative cycles.
Well, I come at it from a different way.
Oh.
Yeah. The RCA collapse is not proof that the market is a theater of stories. It is empirical proof that gravity always wins.
Gravity?
Yes. I mean, the concept of the market as a narrative engine is seductive, absolutely. Stories create these massive, temporary dislocations. But, when the era of cheap capital ends, only real infrastructure survives.
But the narrative is what built the valuation in the first place.
Sure, but the narrative surrounding RCA in 1929 was a complete distraction from the mathematical reality of its cash flows. That $2.62 price point at the bottom, that wasn't an accident.
You don't think it was driven by pessimistic sentiment?
Not at all. That was RCA's actual infrastructural worth, stripped of the psychological premium. Cash flows and operational maturity dictate the terminal value of an asset.
That's an interesting point, though. I would frame it differently. The narrative isn't merely a distraction from the fundamentals.
What is it then?
It's the mechanism that actively alters them. I mean, George Soros formalized this concept through the theory of reflexivity, right?
Right, reflexivity.
The market is not a passive observer calculating intrinsic value. It is an active participant in creating it. The loop operates like this perfectly engineered engine.
Walk us through the loop.
So a new narrative emerges, which drives the equity price upward. And that rising price stirs human emotion, greed, fear of missing out, professional envy.
Which then fuels liquidity.
Exactly. Massive influxes of liquidity. And that liquidity hardens the narrative, turning what was once a fringe theory into institutional consensus.
But it's still just a story at that point.
Well, here is the critical part of reflexivity. It's the mechanical advantage a high stock price provides. When a company's narrative drives its valuation to the stratosphere, its cost of capital plummets.
Right, they can issue more stock.
Yes. They use that inflated stock as currency to acquire real, cash-generating businesses. They aggressively hire top-tier engineering talent by offering lucrative stock options.
So the story creates the capital.
And the capital builds the reality. The loop is the reality, at least until the cycle matures.
I'm sorry, but I just don't buy that. Let me tell you why.
Go ahead.
Reflexivity assumes that a manipulated cost of capital can permanently outrun a structurally flawed business model.
Not permanently, but
it suggests that if you pump enough narrative liquidity into a story, it magically becomes a durable asset. But the math always catches up. You cannot use inflated equity as a magical currency forever if the core business bleeds cash.
well, the loop does stall eventually.
It doesn't just stall. When the narrative outpaces the mathematical reality by an extreme margin, it violently reverses. The moment a critical piece of bad news breaks the spell, like a missed earnings report, the liquidity instantly vanishes.
And the cost of capital skyrockets overnight.
Exactly. The talent leaves because the stock options are suddenly underwater. The crowd that drove the price to the heavens trample each other rushing for the exit.
It's a harsh unwinding.
You can manipulate your runway temporarily with a good story, but you cannot permanently sustain a $500 stock on $2 of actual infrastructural value. The numbers dictate survival. Everything else is just psychological noise.
Well, if we view that psychological noise objectively, we actually see that it organizes itself into highly predictable patterns.
Predictable?
Very predictable. Every market story passes through a strict sequence. There are 4 distinct seasons to a narrative cycle, right? Winter, spring, summer, and autumn.
The 4 seasons. Okay.
And the critical skill in markets isn't merely identifying the fundamental quality of the business, it's identifying the exact temperature of the story you're invested in.
Well, the mechanics of these seasons are entirely grounded in fundamental realities, though. Let's look at winter, or what we categorize as the Valley of Despair.
Right, the deepest chill.
The textbook example is the cryptocurrency landscape in early 2019. The market had suffered a brutal, unrelenting unwind. Bitcoin was languishing near $3,000.
The media headlines were brutal, uniformly declaring it a failed experiment.
Mainstream coverage had completely evaporated. It was an environment of profound psychological desolation. And this is key, this is exactly where the fundamental reality diverges from the public narrative.
Because they were building.
Exactly. Beneath the frost of that winter, the core infrastructure was expanding. Look at the hash rate, the aggregate computational power securing the network.
While the price was crashing, the hash rate was making new highs.
Yes. The core developers were quietly deploying foundational upgrades. Winter is the season where innovation is entirely ignored by the broader market. Prices are compressed to their absolute minimums.
And only domain specialists remain engaged.
Right. This is where deep generational value lives. You require assets at a discount to their structural integrity. But extracting that value requires enduring deep loneliness, because the narrative provides zero external validation.
And that deep loneliness only breaks when the market transitions into spring, right? The green shoots of recovery.
Which requires a serious catalyst.
It does. It requires a catalyst that forces the math to overwhelm the dead narrative. Consider the resurrection of Meta in early 2023.
Oh, that was quite the turnaround.
Unbelievable turnaround. The company had endured a catastrophic 76% decline from its peak. It bottomed out around $90 per share, I think?
Something like that. The prevailing narrative was intensely toxic.
The consensus view was that Meta was dead money. The pivot to VR was seen as a historic capital allocation error, and the core ad business was supposedly in terminal decline.
The winter was deep.
Very deep. But then, Mark Zuckerberg announced the year of efficiency. And mechanically, this wasn't just a PR pivot.
No, he initiated aggressive structural reductions.
Headcount cuts, slashing capital expenditures. He fundamentally altered the terminal growth assumptions in every analyst's discounted cash flow model.
Because by removing billions in projected future expenses, the mathematical present value instantly increased.
Exactly. And the psychological impact was profound. Doubt slowly transitioned into curiosity, and that curiosity hardened into conviction.
Institutional capital quietly began to accumulate shares.
The media tone shifted from outright mockery to this cautious, begrudging optimism, and the stock surged 400% over the next 18 months. Spring is the exact moment when the operational reality forces the narrative to painfully reevaluate the asset.
But spring inevitably gives way to summer, which introduces a profoundly dangerous psychological state.
The heat of euphoria.
Right. The market transitions from cautious optimism into pure delusion.
Precisely. Summer is characterized by the concept of narrative stacking.
Narrative stacking.
Look at the mechanics of Peloton in late 2020. At its peak, Peloton was no longer being valued as a manufacturer of stationary bicycles with screens.
No, it became a complex abstraction.
Right, a multi-layered abstraction. The market stacked 4 distinct narratives on top of each other to justify a valuation that, frankly, defied basic physical constraints.
What were the 4 pillars?
First, the macroeconomic belief that COVID-19 had permanently altered human behavior. Home fitness was the eternal future.
Right, the new normal.
Second, the software-as-a-service narrative. It wasn't about hardware sales. It was about recurring high-margin subscription revenue.
Valuing it like a tech company.
Exactly. Third, the cultural narrative, driven by celebrity endorsements and immense social cachet. And fourth, the broader secular health and wellness revolution.
And each of these pillars reinforce the others in a feedback loop.
Yes, analysts were trapped in a cycle of perpetually raising their price targets simply to match the explosive price action. Retail investors were buying every minor dip with absolute conviction.
Summer is when the story becomes unassailable consensus.
And any dissenting fundamental analysis is actively mocked.
That's a compelling argument. But have you considered that narrative stacking is actually the ultimate indicator of structural fragility?
How so?
Well, when you require four distinct, complex macroeconomic and cultural phenomena to converge perfectly just to justify a company's multiple, you've built an edifice on highly unstable ground.
A house of cards.
Exactly. The market incorrectly interprets the stacked narrative as an impenetrable moat, but if even one of those pillars wobbles, the entire valuation structure undergoes a catastrophic failure.
Like gym's reopening.
Yes. In Peloton's case, it was the simple, inevitable reality of physical gyms reopening. Once the quarantine narrative cracked, the churn rate mathematics destroyed the software-as-a-service narrative.
And the cultural cachet evaporated as the hardware piled up in secondary markets.
Right. The strongest fundamental stories in business history are incredibly simple and mathematically robust. They do not require a confluence of once-in-a-century global pandemics to validate their cash flows.
That makes sense. The more exotic reasons required to explain the price, the closer you are to the precipice of autumn.
And autumn brings the sudden, violent chill. The transition from summer to autumn is rarely a gradual deceleration.
No, it's almost always an abrupt phase shift.
It's the most violent of the four seasons, because the mechanical unwinding is immediate. Let's examine Netflix in the first quarter of 2022.
Ah, a classic autumn case.
For a decade, the Netflix narrative was one of perpetual, uninterrupted subscriber growth. That was the singular metric that mattered.
The foundation of its premium multiple.
Exactly. Then, for the first time in 10 years, they reported a net loss in subscribers. The transition occurred overnight. The perpetual growth story shattered instantly.
Because the terminal growth rate was permanently downgraded.
Yes. The assumption of how big the company could ultimately become was slashed. The stock plummeted, and the exact same analyst who had been pounding the table to buy the stock just weeks prior, they raced to issue brutal downgrades to protect their reputations.
The media pivoted from declaring the company an unstoppable monopoly to analyzing its imminent demise.
And institutional portfolio managers, driven by strict risk management mandates, liquidated their positions mechanically.
That is the hallmark of autumn. A single piece of fundamental reality decisively breaks the core narrative pillar, liquidity reverses direction aggressively, and the crowd stampedes for the exit.
So, how does an investor avoid getting caught in that stampede?
Which brings us to the phase transition test. How does an observer objectively identify when summer is ending and autumn is beginning before the violent unwinding occurs?
It has to rely on market mechanics, not just personal opinion.
Exactly. Ask yourself this. If a company releases objectively stellar news today, a massive earnings beat, a surprise product launch, a major strategic partnership, would the stock price actually surge? Think about this for a second.
That's a great test.
If the honest, observable answer in the market is muted, if the consensus reaction is, it's already priced in, you are standing at the absolute edge of the autumn cliff.
Because the narrative is maxed out.
Right. When a narrative becomes so crowded, so overwhelmingly consensual, that only absolute, flawless perfection can sustain the current valuation multiple, the next directional move is almost mathematically guaranteed to be a violent reversion downward.
There's simply no marginal buyer left to push the price higher. The story has consumed all available liquidity.
Precisely.
This dynamic perfectly illustrates the danger of ignoring the fundamental limits of a business. And these seasonal transitions we've just mapped out, they aren't mere metaphors or behavioral theories.
No, they are the underlying mechanical drivers of market returns.
Comprehensively proven by recent empirical data.
Exactly. This is the exact tension explored in the 2026 Financial Analysts Journal study, authored by Chen, Huang, and Zhang.
An explosive piece of research.
Seismic shift in empirical finance, really, because it quantifies the exact premium generated by narrative transitions. For decades, the foundational dogma of quantitative investing has been the binary battle between value and growth.
The classic paradigm.
Right. The conventional wisdom institutionalized by trillions of dollars in passive index funds rigidly states that value stocks outperform growth stocks over a long-term horizon due to the perceived value premium.
You buy value because it's cheap, or you buy growth because it's expanding.
But Chen's team analyzed over 60 years of stock return data and completely dismantled this static framework. They discovered that the true alpha does not reside in the label itself.
So static holding doesn't work.
If you isolate the stocks that just sit statically in their respective categories year after year, the returns are entirely mediocre. The alpha resides entirely in the movement between the labels.
The transitions.
Yes. Every single year, roughly half of all value stocks and half of all growth stocks are newly categorized. They just crossed the boundary. The study proves conclusively that these transition stocks, the ones moving from one bucket to the other, carry a statistically massive return premium.
The implications of this are staggering when you look at the underlying mechanics of institutional finance. Consider what happens mechanically when a growth stock transitions into the value category.
It means the narrative just died.
Exactly. The core story that justified its premium price-to-earnings multiple, the absolute conviction that the company would compound its revenue indefinitely, has collapsed.
We're looking at the clock hand, moving violently from summer to autumn.
The multiple compresses, the revenue growth decelerates, and the broader market officially orphans the stock, dumping it into the value bin. But here is the critical mechanism. When major indexes like the Russell 1000 rebalance, portfolio managers are mechanically forced to sell the stock out of their growth portfolios and buy it in their value portfolios.
And the reverse is true as well.
Yes. Conversely, when a value stock transitions into the growth category, it signals the birth of a new narrative. The company executed a successful restructuring, launched a disruptive product, or benefited from a tectonic shift in its end markets.
The clock moves from winter to spring,
triggering a massive wave of forced institutional buying as the stock is added to growth indexes.
I see why you think that, but let me give you a different perspective on the most explosive finding in this data.
Oh?
It is not just that transitions generate a premium due to institutional rebalancing. It is where that premium is actually sourced. The study reveals a truth that completely defies human intuition.
What's the source then?
The massive return premium generated by transition stocks is driven primarily by the severe underperformance of new growth stocks.
Wait, really? The new growth stocks?
Yes. These are the former value names that recently acquired the growth label. When a company shows initial signs of a turnaround, the market latches onto the story and bids the price up aggressively, pushing the stock into growth territory.
But the fundamentals haven't caught up.
Exactly. The underlying fundamentals have not actually caught up to the narrative. The market is trading on the assumption of a sustained recovery before the actual cash flows validate it.
So the multiple expands far faster than the earnings.
The clock says spring, but the operational weather inside the company is still deeply winter. The alpha exists for the sophisticated observer because the broader market systematically misprices the velocity of the turnaround.
The momentum traders push the valuation to a level that the underlying business cannot physically support.
Precisely. I have to admit, that specific finding regarding the severe underperformance of new growth stocks is genuinely shocking. It exposes the inherent danger of consensus momentum.
It really does. The market falls in love with the idea of a recovery significantly faster than the recovery can mathematically occur. Ambient force that operates identically in all conditions.
No, it's amplified by macro triggers.
Violently amplified. The Chen study isolates economic contractions as a primary catalyst. When the broader economy weakens, fragile narratives are the first casualties.
The discount rate wall.
Exactly. What we call the discount rate wall tightens aggressively. Let's break down the mechanism of the discount rate. If a company is a long-duration growth stock, meaning the bulk of its expected profits are projected to occur 10 or 15 years in the future, those future profits are highly sensitive to the current cost of capital.
So if the Fed acts.
Right. If the Federal Reserve raises interest rates from 0% to 5%, the mathematics of discounted cash flow dictate that $100 earned a decade from now is worth significantly less today.
The narrative of the company didn't change. The mathematical gravity changed.
Exactly. Stocks that were entirely dependent on these long-duration stories are subjected to a brutal, unforgiving audit. The highest premium in the entire Chen study is generated by stocks transitioning from growth to value during these specific tightening cycles.
Precisely because the market is forcibly purging the speculative excess.
Yes.
And that purging process reveals the across-industry effect, which is a critical nuance of the narrative cycle. When the Federal Reserve tightens and the cost of capital rises, the narrative cycle operates at the highest macro level.
It's not isolated.
Not at all. It isn't just an isolated phenomenon affecting only highly valued tech software companies. The clock moves for everyone simultaneously. You see the transition sweep across consumer discretionary, biotechnology, media, and retail.
All crashing at once?
All of these sectors experience the death of their respective growth narratives at once because the discount rate is a universal metric. This is precisely why a purely bottom-up fundamental investor is operating at a severe disadvantage.
You can't just look at a spreadsheet.
Right. It's insufficient to simply identify a statistically cheap company on a spreadsheet and wait. If you don't understand whether the overarching macroeconomic environment is accelerating or decelerating narrative transitions, you cannot determine if the value premium you are chasing is a genuine structural advantage or if you are simply catching a falling knife in slow motion.
The macro environment dictates the speed of the transition.
It absolutely does.
So if we accept that the narrative transition is the primary engine of market returns, the paramount question becomes one of fundamental survival. How do you objectively distinguish between a temporary narrative collapse and a permanent destruction of capital?
The concentric circles.
Yes. This requires an examination of what we term the concentric circles and the strict application of the crash floor test.
Which is essential.
After every cyclical crash, when the liquidity evaporates and the narrative dies, the dust eventually settles. And we must ask a purely mechanical question. Did the preceding era of innovation deposit real, enduring infrastructure, or was it purely an illusion of financial smoke and mirrors?
I'm glad you brought that up, because the perfect, undeniable manifestation of the expanding concentric spiral is NVIDIA.
The modern gold standard. Yeah.
Let's trace the mechanics of their monumental ascent, from 10 billion to 30 billion to 300 billion, and ultimately to a market capitalization exceeding $3.4 trillion.
A staggering climb.
Throughout this journey, NVIDIA endured multiple vicious cyclical drawdowns, where the prevailing narrative completely collapsed. But in every single cycle, the company deposited concrete, unassailable infrastructure.
Starting with graphics.
Right. They began by dominating pure graphics processing for gaming. The narrative peaked, then crashed. But beneath the surface, they parlayed that hardware dominance into the creation of CUDA.
Their parallel computing platform.
Exactly. Once developers learned to write complex code on CUDA, they couldn't easily port that software to competing hardware. NVIDIA established a sticky software moat wrapped around a physical product.
Which became the foundation for everything else.
That software dominance, then, became the absolute foundation for their monopoly in data center architecture for artificial intelligence. Following every single market crash in NVIDIA's history, such as the crypto mining bust in 2018, their fundamental price floor held structurally higher than the peak of their previous cycle.
An expanding spiral.
Every concentric ring of innovation solidified into a permanent operational platform for the next expansion. The market narrative frequently overheated, yes, but the technological and financial infrastructure beneath it was profoundly real and continually compounding.
I acknowledge the NVIDIA precedent. It is the modern gold standard of the expanding spiral, but I come at it from a different way when looking for the ultimate stress test of this concept.
Which company?
Let's examine Amazon in the year 2000 for a much more harrowing evaluation of survival.
Oh, the dot-com implosion.
Amazon's collapse was apocalyptic. The market capitalization disintegrated from $30 billion down to roughly $6 billion.
To the broader market, Amazon looked identical to Pets.com or Webvan.
Just another catastrophic casualty of a euphoric era where the narrative completely divorced from reality. But, and this is the crux of it, the core infrastructure survived the destruction of the story.
The crash floor held.
The physical warehouses remained operational and were heavily optimized during the downturn. The complex logistics network continued to route packages with increasing efficiency. Most importantly, the core customer database remained intact and actually expanded.
So the fundamental business was growing while the stock was dying?
The narrative crash was undeniably brutal, compressing the valuation by 80%. But the foundational mechanics of the business endured the winter. From that $6 billion crash floor, the physical infrastructure scaled relentlessly, eventually driving the valuation to over $2.3 trillion.
Deep value was created because the market confused a dying narrative with a dying business.
Precisely.
Which stands in stark contrast to the contracting trap, where the business survives, but the valuation never recovers.
Exactly. We must dwell heavily on the dark side of this equation. Look at the mechanics of Cisco systems in the year 2000.
Cisco was the undisputed backbone of the internet infrastructure build-out.
They manufactured the literal physical routers that powered the web. At the absolute apex of the euphoria, Cisco commanded a market capitalization of $555 billion, trading at over 200 times its earnings, generating roughly $20 billion in revenue. The narrative circled the market's projection of Cisco's future dominance and infinite growth was mathematically 50 times larger than its actual fundamental circle of cash generation.
The narrative ran way too far ahead.
When the macro environment shifted and the cycle broke, Cisco did not just suffer a temporary drawdown, it was permanently trapped by multiple compression. For the next 2 decades, despite remaining a highly profitable, dominant enterprise that successfully grew its earnings, the stock price never recovered its former glory.
It languished in a permanent range.
Between $100 and $250 billion. The physical internet routers they built were real, but the valuation premium attached to them was a permanent illusion. The multiple compressed from 200 down to 15. The fundamental circle grew, but the narrative contracted so violently that it never expanded again.
I'm not convinced by that line of reasoning because Cisco still maintained a real, tangible business. If Cisco is a tale of multiple contraction on a real business, General Electric is the ultimate tale of a complete corporate mirage.
GE in the late 90s, right?
GE was universally revered, peaking at a $600 billion valuation. The narrative was that GE was an invincible industrial powerhouse, driven by superior product engineering and flawless management.
But the underlying reality was deeply compromised.
Exactly. The vast majority of that valuation wasn't derived from building hard infrastructure or jet engines. It was entirely predicated on the opaque financial engineering of GE Capital.
They were basically acting as a shadow bank.
A highly leveraged, unregulated shadow bank using short-term commercial paper to fund long-term illiquid assets. The earnings were an accounting illusion.
And when the great financial crisis hit,
When the broader financial narrative collapsed and the credit markets froze, the illusion shattered instantaneously. The company lost nearly 90% of its value, plummeting towards $60 billion.
the concentric circle wasn't expanding through infrastructure at all.
No, it was merely inflated by extreme leverage. When the leverage was forcibly unwound, there was no foundational crash floor to arrest the decline. The core industrial businesses were stagnant and the financial engine was bankrupt.
This leads us directly to the definitive formulation of the rule.
The crash floor test.
When evaluating a company in the immediate aftermath of a narrative collapse, the geometry of the historical price action, combined with the operational cash flows, tells the true story of the fundamentals.
If the crash floor holds structurally above the prior cycle ceiling,
Then the concentric spiral is mathematically expanding. The infrastructure is real, the business is compounding its internal value, and the mandate is to aggressively accumulate the asset in the aftermath of the panic.
but if the crash floor falls below the prior peak,
The fundamental circle is contracting. You are looking at a classic value trap. The survivors of a market panic are those companies who spent the euphoric summer building hard infrastructure and solidifying their balance sheets.
And the permanent casualties are those who spent the summer building better pitch decks and leveraging their equity.
Exactly.
But we can't evaluate the business in a vacuum, completely isolated from the external sentiment of the broader market. We have to synthesize these mechanics into what we call the dual clock system.
Right, bringing it all together.
Every single investment is governed by the continuous dynamic interaction of two distinct chronometers. The sentiment clock, which measures the psychological and emotional temperature of the broader market, and the corporate maturity clock, which measures the actual operational, infrastructural, and financial progress of the enterprise.
And the alchemy of investing is understanding exactly where these two clocks intersect at any given moment.
That is the true source of sustainable alpha.
Then let's rigorously map the fundamental mechanics of the four possible combinations. The most toxic, catastrophic setup in all of finance is when immense market euphoria intersects with corporate immaturity.
A mathematical recipe for absolute disaster.
We returned to Peloton in late 2020. The sentiment clock was striking midnight in the dead heat of summer. The market euphoria was absolute, driven by a perfect storm of macroeconomic anomalies.
But the corporate maturity clock was barely passed on.
The business was profoundly immature. They possessed unproven, untested unit economics. They had a highly constrained and narrow product ecosystem. And crucially, they possessed a brittle supply chain that had never been stress-tested by a normal economic cycle.
The market narrative ran thousands of miles ahead of the operational reality.
When the sentiment inevitably broke as gyms reopened, there was no fundamental infrastructure, no robust recurring cash flow to act as a parachute. The result was a swift, irreversible 96% destruction of capital.
Conversely, the definitive sweet spot, the most mathematically asymmetric risk-to-reward ratio available to an investor, is when the spring of recovery meets profound corporate maturity.
The Meta 2023 scenario.
Exactly. The sentiment clock was just beginning to thaw from a brutal, unforgiving winter, entering an early, highly skeptical spring. The broader market still largely despised the stock.
But the corporate maturity clock was highly advanced.
Meta possessed one of the most robust, high-margin, unassailable cash flow generation engines in modern corporate history, supported by an entrenched global user platform encompassing billions of daily active users.
So the narrative wasn't running ahead of reality.
No, it was desperately, violently trying to catch up to an ignored reality. The intersection of deeply discounted pessimistic sentiment with massive, highly mature cash generation is the exact mechanical engine that fuels a 400% rally from the trough.
But we must also navigate the insidious trap of euphoria, meeting a declining business. This is arguably the most dangerous game an investor can play, precisely because the underlying operational decay is completely masked by societal consensus.
General Electric fits this quadrant perfectly.
Perfectly.
The market was universally euphoric, celebrating the company as an invincible technological and managerial juggernaut. It was the premier blue-chip holding in almost every institution portfolio.
But the core industrial businesses were already rotting, stagnating under the immense weight of corporate bureaucracy and a severe lack of true technological innovation. The market's immense hype provided a temporary, highly effective camouflage for the operational decline, while financial engineering propped up the earnings per share.
When the truth finally forced its way to the surface, the collapse erased decades of perceived wealth.
The business was dying while the crowd was cheering.
Which brings us to the final, most isolated quadrant: collapse meeting a stable business. This is the exclusive domain of deep generational value.
Post-2000 Amazon is the absolute archetype of this dynamic.
The sentiment clock was completely broken. The market was in a state of absolute, unyielding despair regarding anything remotely related to the internet or e-commerce. The narrative was dead.
But the corporate maturity clock was quietly, methodically advancing.
Amazon was aggressively expanding its physical logistics footprint, lowering its internal cost of capital, and systematically growing its core, fiercely loyal customer base.
The market's complete abdication of the narrative created an extraordinary mispricing of the underlying compounding infrastructure.
The fundamental reality was expanding rapidly, completely hidden beneath the wreckage of the dot-com crash.
The fundamental lesson extracted from these four quadrants is critical for capital preservation.
It really comes down to the lag between mood and math.
Exactly. The highest probability of outsized returns occurs exclusively when the market's psychological mood significantly lags behind the mathematical, infrastructural reality of the business.
And the greatest risk of absolute ruin occurs when the mood runs recklessly ahead of the math, demanding a future that the company cannot physically engineer.
So to apply this synthesis practically in real time, we prescribe a strict weekly protocol. As an investor navigating these relentless cycles, you must rigorously ask yourself 3 specific questions every single week.
Let's hear them.
Question 1. What narrative is currently dying? According to the extensive data in the 2026 Chen FAJ study, this exact transition zone, the movement from growth to value, is where structural alpha is generated.
When the consensus has abandoned it.
When the media declares it uninvestable and the story is left for den, you hunt for the survivors. You meticulously look for the companies whose crash floors are holding.
Real infrastructure, durable cash flows.
Operating quietly beneath the wreckage of the public narrative. Question 2. What anomalous price action or massive capital investment is occurring right now that possesses absolutely no narrative yet?
You're looking for the data before the story's written.
The most powerful fundamental signals in the market always manifest in the raw data, long before the financial media crafts a coherent story around them. Look for unexplained, sustained surges in capital expenditures, or quiet, systematic price accumulation in sectors that are currently ignored. This is the precise location where the infrastructure of the next cycle is gestating in the dark.
And the third question?
Question 3. What feels entirely obvious to me right now?
Checking your own bias.
If a macroeconomic thesis or a specific company's trajectory feels universally accepted and logically unassailable, you are standing in the dead heat of summer. Consensus is the ultimate proven enemy of forward returns.
The Chen study proved this mathematically with the new growth stocks.
Exactly. The highly visible companies that the crowd has uniformly decided are the next undisputed champions of the economy. They systematically underperform the broader market. The institutional momentum traps retail capital. The crowd is historically reliably late to recognize the transition, continually buying the narrative long after the fundamental reality has peaked.
Ultimately, we arrive at a shared framework, even if we weigh the initial variables of sentiment versus fundamentals differently. Euphoria transposed onto an immature, structurally fragile business is a mathematical and financial death sentence.
And a narrative recovery applied to a deeply mature, highly profitable, cash-generating business is the absolute engine of outperformance.
The Chen study provides the undeniable empirical proof that surviving the death of a dominant narrative and actively capitalizing on the forced institutional transition of labels is the most profitable event in modern financial markets.
It is the core mechanism of wealth creation.
So I will leave you with this final forward-looking thought to dissect. Look closely at the heavily concentrated, highly valued, dominant companies driving the major indices today. Examine their core mechanics. Which ones are meticulously constructing an expanding, unassailable spiral of hard, enduring infrastructure, and which ones are simply stacking increasingly fragile narratives, waiting for a single, inevitable macroeconomic pillar to snap?
That is the essential question. This is the Research Desk officially signing off.